Hello and welcome to this special show. Scripbox presents Building Wealth in a VUCA World, co-powered by HDFC AMC and IIFL AMC. VUCA, you've heard that word, but what does it mean? Well, VUCA stands for volatility, uncertainty, complexity and ambiguity. It's a heavy word, but it is so relevant today because the world that we live in is all of that. So how does that impact our propensity to build our personal finance portfolio? I've got three experts here with me and we'll be talking about that, how things have changed, what's the way ahead, and most importantly, how we can continue building wealth in a VUCA world. Allow me to introduce my panelists. We have Roshi Jain. She's Senior Fund Manager Equity at HDFC AMC. Hi Roshi, thanks so much for being here.
Hello, pleasure.
We have Atul Singhal. He's the founder and CEO at Scripbox. Hi Atul, thanks for being here.
My pleasure entirely.
And we have Anup Maheshwari. He's co-founder and Chief Investment Officer at IIFL AMC. Thanks Anup for being here with us.
Thanks, man.
Atul, let's start with you. Okay, currently if you hear people, you hear the big economists around the world, World Bank or any other big forums, it sounds all doom and gloom. People are saying get ready for a global recession, etc., etc. Some say that, hey, India will not be impacted, etc., whatever. But in this scenario, what should people be doing? Should we give in to the fear? Should we get out of equity, go in for safe fixed return assets? Or is this just ignore the noise and keep going with our plan?
Yes, there is global uncertainty, absolutely. We can't ignore what's happening in the world, whether the Russia-Ukraine conflict or the increasing Fed rates, the high inflation, which the Western world has never seen. And there is a global connectivity. Mm-hmm. But we should feel happy about where we are in India. Mm-hmm. Right? We have seen a 6%, 7% GDP growth rate. We've seen the PLI incentives come through. We've got the demographic dividend on our side. So on balance, I would say that investing is not about following crowds. Investing is not about, it's about what you need to achieve with your money. Mm-hmm. You want to put your children through college, you want to retire happily, you want to buy that bigger house. And all of these require a systematic plan. Right. Some require fixed income products, some require sort of inflation beating products. So again, depending on your goals, I think, yes, ignore the noise, stay with the signal, stay committed. As we always say at Scriptbox, stay invested, keep investing. Stick to your asset allocation plan broadly.
Anup, just taking this ahead, because there is another adage that says, be greedy when others are fearful and be fearful when others are greedy. People are fearful. So is this the time to be greedy and say, okay, let me put in more money in there? And what's your take? It's the other side of the coin, but what's your thought?
Sure. So, from an equity standpoint, we always encourage everyone to take the longer term view. And the longer your period of time frame of investing, the less relevant it is exactly when you invest it. But for whatever it's worth, we sort of work with a very broad range of risk reward that we talk about when you're looking at particularly valuations of the market. And just to give you a perspective on that, if you look at investing in India, generally speaking, the longer term average valuation has been about 3 times price to book. We look at something called price to book. Mm-hmm. We found that to be a very good long term indicator. And 3 times is pretty much fair value. When the market is 1 standard deviation above, it's about 3.8 times. 1 standard deviation below is about 2.4 times. And depending on where you are in that spectrum, you get a sense on the risk and reward that you're taking. Just to put in perspective, right now we're at 3.4 times price to book. So we're just encouraging everyone to continue to do systematic allocation. So when you're above average, keep doing SIPs. When you go below average, you can consider lump sums. And at those extremes, that's when you think about asset allocation.
But the important thing is stay invested and keep investing. So that is a very important point there. Roshi, with some of the advanced investors who are watching our show would be invested in global markets also.
Sure.
Is this the time for them to maybe liquidate global market investments and put that money into India?
So, global investing to my mind is a very broad term because you could be talking about the US, you could be talking about emerging markets, you could be talking about global tech, you could be talking about global commodities. So I think when we say global investing, we just need to be careful and sure about what we are talking about. Each country, each sector has its own economic cycle, industry cycle, and therefore you don't want to be caught in this catch-all global investing sort of terminology. we need to ask ourselves, where in our asset allocation plan does global investing come in? How does it gel with the need for diversification, risk appetite importantly? And at the second level, we need to ask again, what are the economic drivers of this particular country or theme? What are the long-term prospects? Investing, whether in India or globally, is about long-term investing. So I think I would be doing a disservice by giving a yes or no answer. I think we need to ask ourselves these important questions before we decide.
Atul, one important point is also that, like we started when we said, so many experts speaking about things. There are global experts, there are domestic experts, there are so-called experts on social media. Everybody is an expert, so to say. Any investor, whether it's a newbie or an advanced, how should they figure out the music from the noise? How do they, ignore the chatter and take in the right advice?
So while investing somehow seems like a dinner conversation topic very often, I bought this stock and I did this, nobody talks about their losses, right? Everybody talks about only their gains. So unless you're trusting somebody to walk with you on the journey, and without sounding to push my brand, we see our role as a Maji, as a boatman. We'll take you across troubled waters, we'll take you across smooth seas, we'll take you across the river. So it's our job to work with our customers. So coming back to so don't trust what they call the experts. Figure out who's on your side, figure out your boatman, figure out your coach, and walk the journey with them. And wealth is a multi-generational thing.
Right.
It's not about how much money I made this week, last week, next month. It's the next 30, 50, 70 years. That's how wealth gets created.
Anup, we were just, Atul did talk a little bit about fixed deposits when he was referring to Mr. Kamat's quote. But if you look at fixed deposit rates right now, they're, I wouldn't say all-time high, but they're quite high as opposed to what they were earlier. So is this a time when, again, people would be wondering that, hey, is this the right time to put money in fixed deposits? At least I'm getting an assured return, and maybe in this volatile market scenario, maybe not put in equity. But how do you answer those questions if they come to you?
Ideally, it shouldn't be one versus the other. It's part of an asset allocation, really. But you're right in the sense that interest rates are a little more attractive than they were earlier. So to that extent, we're already seeing, in terms of, if you look at mutual fund flows recently, we are already seeing investors sort of seemingly moving a little way towards fixed income. But that's a short-run phenomenon. In the longer run, equities does tend to outperform bonds. That's why stock markets exist. Typically, when interest rates are high, it's natural to expect some migration, because higher interest rates tends to sort of be a little negative for equities. We always know that rising interest rates is bad from an equity standpoint, and therefore in a rising interest rate environment, you'd expect some people to be moving into fixed income. Right. But again, it's really a matter of time frames.
Atul, quick point to you before I move to Roshi is, high interest, high inflation, and people would still be expecting maybe a 12% plus return on equities. So how do you talk to them? What should be the game plan?
So your asset allocation has to be, and I know it's like a broken record. Your asset allocation has to be aligned to your goals.
Right.
And in terms of return expectations, coming back to, returns basically are a combination of inflation plus real growth rates, right? And India has tended to be either high inflation or high growth, right? Yeah. That's not coincided together. So if you take today's growth rates at about 6% and inflation at 6%, can you expect 10 to 12% returns? I think that's reasonable, again, long term. If you take a 5, 7, 10 year view, absolutely. But the 17%, 12, 15, 17% we saw in some markets is unlikely, right? That's at least how we are setting our customer expectations. That inflation is coming down, and as inflation comes down, you also don't need to have such high returns. Essentially, your returns have to be aligned to be beating inflation. Right? If inflation is at 4% and you got 6% more than that, your money is growing fast enough, right? Okay. So that's as long as inflation is controlled, I think return expectations can be suitably tempered down.
Right. Well, on that note, it's time for a very short break here on Scripbox presents Building Wealth in a VUCA World, co-powered by HDFC AMC and IIFL AMC. Don't go anywhere. We'll be right back. Welcome back to Scriptbox presents Building Wealth in the VUCA World, co-powered by HDFC AMC and IIFL AMC. I'm in conversation with three experts. We have Anup Maheshwari, Atul Singhal and Roshi Jain. Roshi, is this the right time maybe to look at the high risk, high reward investments like maybe small caps or equities or mutual funds or mid caps? Is this the right time?
So, the one thing that I've always believed is it's never the time to be reckless in stock markets. If you're talking about high risk with the perspective of being reckless, the answer is it's never time to be reckless. I think when we say high risk, high reward, we are generally looking at a period of perhaps low valuations as well, because in that scenario, either there is impending gloom or you are living in a period of perhaps poor macroeconomics environment. It's that combination which generally gets associated with high risk, high reward. To my mind, valuations yet are not as attractive. So I continue to believe that over the long term, the structural outlook for India is extremely positive. I think we are one of those countries which has opportunities in various spheres and therefore the ability to diversify as well, whether it's consumption, whether it's exports, whether it's infrastructure, manufacturing. And therefore, I think an ideal portfolio should be one that is able to capture these diversified sectors, at the same time not overlooking the valuation aspect as well.
Anup, today's era is very different from a few years ago. Why I mean is more technology, so people have more access to information as well as options, because now first there was the EMI era, we were getting used to it. Now we have the BNPL era, so you buy now, you pay later. How do you talk to investors who have so many easy avenues to spend? They have easy avenues to invest as well. The brightness, the excitement in the easy avenues to spend, I feel, is sometimes takes up more attention. So how do you steer those conversations?
Yeah, I think I think Warren Buffett said this really well actually. He said, came out with this very interesting line. He said, don't save what's left after you spend, but spend what's left after you save. Right? And that principle really works in real life. Saving and spending are two separate buckets. You've got to make a budget. If you make a budget of what you're spending and saving, then you know where your money goes. Otherwise, you wonder where your money goes eventually if you don't have that. And it's easy to spend in today's economy, but the fact is, saving produces a compounding effect that actually increases your spending power in future years. And that's something you need to always put in perspective.
I'll add to that. One of the things you were talking about when we started this was about education, and we insist that 20% of your income has to be saved. So we actually want to change the name of SIP, which everybody uses, to CMI. It's a committed monthly investment. That you're committing that for the next 20 years of my life, 20% of my income, and it goes up to 30% when you're 40 and 40% when you're 50 and more. So I think just that systematic or commitment that I will put this money aside, like my rental or my school fees or my home loan EMI, it's that discipline which is really, really important.
Roshi, the other thing, what happens is what you were earlier talking also about these, looking at these things holistically, not just balancing your one decision on one event or one question. Now, everybody says that you should be reviewing your asset allocation periodically. Some say maybe once a quarter, once half year, or once a year. But is that the right way to do, or should this be around global events? So, for example, the union budget comes out in India, or Fed is raising its rates or putting out whatever their policies. Should investors be making changes around that, or no? Just make a plan, stick to that plan.
You of course cannot keep anchoring your investment decisions or asset allocation goals or financial goals around events happening in the world, because then that's all you're going to be doing. There's something happening not every week but every day, perhaps every hour. I would think that a good plan, a realistic plan, is one that would capture the more structural trends, and there would be some auto rebalancing in place in that asset allocation plan that you create, if it is a good plan. And you would that plan would perhaps also be able to take away from many of the structural events or the structural underpinnings from these events, rather than you having to tactically change your asset allocation with with every event. So some of these changes will require you to reassess your asset allocation, but you don't have to do it tactically around every event that is happening either in India or globally. Some of these are changes that you just make maybe even once in a decade, I would say. But Atul may disagree with me. But definitely you don't have to review these goals every quarter or every half year.
Okay, I was going to come to you.
No, absolutely. So I completely agree with Roshi that this is not something your child is not going to go to college in 2 years if they're 12 years old, right? They will go in 6 years from now. So if you take a longer term perspective, you will plan your asset allocation according to those goals. Now, I would think that there are 3 parts to the answer, right? I would trust the fund managers to do what is appropriate to buy the right companies, to watch companies are doing well, what structural changes are taking care. So within any diversified fund, I'm expecting the fund manager to do the right job. My job as the wealth manager is to make sure that I'm aware of the long-term structural trends and my customers' goals, more importantly, and assets are allocated. That said, you should, on a quarterly basis, review the portfolio with your customers. There are structural changes, there are massive corrections. You make small changes. It's not that you sell all equity and get into fixed income, right? If you're overweight in an annual rebalance, if you're overweight beyond 20%, like he had put the one standard deviation. So and luckily for us, and because we are fully digital, all of this is automated, right? We've got rules behind this. These are time tested. So we're able to manage our customers' portfolios quite without too much shock to them or to the system, because customers don't like too much change also, right? Because you have to then explain why, and I think it's important that a combination of stability while being aware of the long-term structural trends and trusting the fund managers from our perspective.
Anup, is this the time to be, so they always say timing the markets is bad, but considering again how I started the discussion and saying that people are saying it's all gloom and doom, is timing the market something that people should be taking into mind this year, or no, just ignore that at all?
So the timing the market argument, frankly, we've been having since Kingdom Come. And the fact of the matter is, if you look at really long periods, again, it's all a function of what periods of time. But, if you literally take the last 30 odd years since 1990, I think markets have compounded at about the Sensex at 13.8% or 14%. And if you missed the best 20 days in that period of time of the last 30 odd years, your returns would almost be half of that, about 7.5% compounding, which is dramatic. And I can guarantee you those best 20 days tend to happen when people least expect it. So the fact is, you have to be in the market for a fairly long period of time to capture those type of movements that will come from point to point. So for the longer part, you want to be exposed to equities. As I said, it's only at extreme valuations that asset allocation tends to come into play, and it makes sense. But by and large, the longer you're invested in equities, at least you don't miss out those very important days.
Absolutely. So using that, the long term, to help ensuring that you get the best of the market days. We're running out of time. One last set of questions. But Atul, I first want to ask you, what happens is with money, and when money is attached or coordinated to these goals, like you said, child's education, someone's marriage, retirement, holidays also, but people get very emotional. How do you talk to these investors? Because I'm sure the day the markets are down, your team must be getting a lot of calls, kya karna hai, nikalne paisa, kya kare, etc., etc., etc. But you have to keep them calm and show them the long picture. So how is that
so
done?
Data helps, right? So he talked about these graphs, and people understand, right? So when COVID happened, I think I remember the phone didn't stop ringing in March of 2020, right? And we kept saying this too shall pass. Not that we knew, right? VUCA was at its peak, right? And we said this too shall pass. We've not seen this before, but look after your health more importantly. Do what you can solve for. Let the markets take care of. The other thing we talk to our customers about, okay, you want to withdraw the money. What will you do with it? So when will you come back, right? So will you come back when the market is lower? When is that lowest low point? Are you the expert? Will you decide when is the lowest? So since there is no science or deterministic point where the bottom is, there's no point pulling out now and coming back later. So it might as well remain invested, right? So our thing is, one is stand behind data, assure them that this too shall pass. And thirdly, say, what are your alternatives, right? So you might, and especially if you're doing a CMI, like I call it, if you're investing every month, the dollar averaging or the rupee averaging and the long-term trend, and you might pick those right 20 days and, and that's what it is.
Absolutely. I mean, look at it this way. If you had withdrawn in March 2020,
you could never come back.
Exactly. It didn't go lower than that so far, touch wood.
I have friends who have done that, who didn't know when to come back, right?
Absolutely. Roshi, just your outlook for 2023, what would you guide our viewers?
So first of all, I would say this. I think it's futile to be either asking or answering the question with discrete periods of time. Okay. The nature of equities is such that over the long term you will make compounding returns, but you try and forecast for the next quarter or the next 6 months, and invariably you will be wrong. So if I were to answer the question, it would be more from a perspective of either satisfying my ego that I'm right or not right, but it's just the toss of a coin. But all I'd say is this. I think if we look at just the structural drivers for India over the next 5 years at least, if not longer, here we have an opportunity to regain some of the share that India has lost in manufacturing. I think government policy is solidly behind that. The demographics we know is positive for us. In fact, China is now seeing declining population. India has a good decade or more to go on that front, and therefore it means more middle class population, more consumption and so on. Try and juxtapose that sort of structural growth and with other countries, and you will find that you will not find too many of them, which ultimately means that a lot of global capital will find India attractive at least over the longer period of time. So let's focus on some of the longer term drivers. Rather than trying and timing it for a quarter or a couple of quarters.
Anup, I will come to you with the same question. I'm trying to see if you have another answer. So the outlook for 2023.
So we tried a bit of a data check on this a few years ago, quite a few years ago actually, in my previous job. And we analyzed ourselves as well as pretty much all our peers. Yeah. And we just wanted to understand where we call it alpha, that's what we are in business for, to outperform the index, that's the alpha. So where were the alpha sources across the industry? And there are 3 sources of alpha, basically: your stock selection in your portfolio, or your sector allocation within the portfolio, sectors higher or lower. And the third is market timing, which is raising cash and then reinvesting it, whatever. And frankly, we couldn't find anyone who's added value on market timing. Zero. In fact, for most of us, it's been a negative drag. So essentially, so it's quite odd that we're asked the question, the first question we asked is on market timing, when none of us have added any value on it for a long, long period of time. Most of the value add comes from stock selection and then some residual from industry selection. That's the bulk of the alpha.
I think get the right advice, be calm, always keep in mind your final goals. I guess those are some of the main points.
And I think just to add to Roshi, that you're in India, right? And as an Indian investor, it is India's decade. I mean, I don't want to sound overly optimistic, but all the structural changes, the demographic dividend, the manufacturing hub opportunity, I think India's got a phenomenal time. So this is a good time to be investing.
Absolutely. That's all the time we have. Thank you so much, Roshi. Thank you so much, Atul. Thank you so much, Anup. Thank you so much for watching. Scriptbox presents Building Wealth in a VUCA World, co-powered by HDFC AMC and IIFL AMC. It was an absolute pleasure talking to the guests, and I hope you're also taking back some important points. Thank you so much for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.